Welcome back to the Robbins Business Show. Great to have you back. Come in, sit down, relax. This won't hurt.
Hardly.
This is episode 2 of 2 episodes about understanding financial statements. I mean, there's a lot of meat there, so we're having 2 episodes. So be sure to watch episode 1 and episode 2, of which this is episode number 2. And I'm Bill Fox, the co-host of the show, but the other co-host is the guy who is absolutely, he's potent. Well, wait a minute, this is a family show. And he's proficient and he's radiant. And he's Coach Robbins.
I like that one. Hey, that's pretty good.
And we, in episode 1, we understanding financial statements from you and Seed Corp.
Yeah, Seed, this is their Seed presentation. The second half, they do a wonderful presentation, about once a month someplace in southeastern Massachusetts, sponsored by a lender, give you free breakfast, free lunch, and this is the afternoon session that they've put together beautifully. And
you actually told me you've been doing this for 17 years. I can't believe it. You got,
I know, 17 years.
You're a very patient guy, Coach.
Yeah, I was just a kid. I was 12 years old.
We went through, we stopped the last episode, Coach.
Yep.
At, we were really getting into either planning or operating your business, whatever your case might be.
Yeah, pricing.
And we were talking about pricing.
Yep.
Especially about, overpricing or underpricing. Right. Proper pricing, you said, is the difference between success and failure.
Absolutely. And how do you determine?
And don't take it lightly.
No.
And just say, well, I'll undercut the other guy.
That's crazy. That's dumb, quite frankly.
So I want to pick up with you.
Yep.
You mentioned overpricing, underpricing. So let's talk about finding the right price.
Yep.
And that would maybe start with ask your customer.
Well, I taught marketing research at Bentley for years. In the very first class, I used to say to them, I'm going to tell you the most important thing you can learn about this market research class before I teach you this, what was then sophisticated software. It was called SPSS. It's probably nothing here 20 years later, but before I do that, I'm going to tell you the most important thing about market research. Go talk to your customers. Be wonderful. And go talk to potential customers. And that's what we're talking about here. If you want to get into a business and you want to search out what price is the right price for whatever it is you're offering, well, you can talk to potential customers and say, would you pay, this kind of money for this product with these features? Because like I say, if you're just trying to give it away at the cheapest, first of all, you're not going to survive very long being the cheapest on the planet. And the other reason is, even if you start off cheap, when you try to raise the prices, people balk, There is such a thing as a market penetration pricing strategy, but that's not part of this program, quite frankly, where you do start at a price that makes sense for the market, but give people a reason to come to you for the initial offering. That's a different story. But charging too much or charging too little, you're not going to stay in business very long. You got to figure out what's the right price. What are people willing to pay me based on what I'm offering them? And hopefully you do have a unique selling proposition. You do have a competitive advantage, that they do perceive value in what you're giving them, and they're willing to go away from where they're getting it and give you their money, even if it's a little bit more money, because they want to get your product or service.
Of course, you could, one thing I want to throw in, it's not on this slide, but I want to say establishing a price. One excellent thing to do would be to know your cost.
Well, you can't. I don't know how you establish a price without knowing your cost. Because
know your cost.
If you go out into the marketplace and do what we're talking about, seeing what people will pay for something, and then your cost, and you can't deliver it at the right cost, and we'll talk about 2 different kinds of costs in this show.
Coach, it's simple. And you're a businessman, and I say, Coach, you're selling these smartphones. How much does this cost?
Right.
And if your answer is, I don't know,
You're in trouble.
you're in trouble.
Yeah, absolutely.
You say, well, gee, I don't know. I haven't checked, or I haven't looked, or
You're in trouble.
You should. I want an answer that says this every unit cost me $300.
Right, and I'm selling it for $6.
And I'm selling it for
Right.
$6. That's
Okay.
what I want to hear you say.
Absolutely.
Okay. You can also shop the competition.
Well, that's a very good thing to do, and see, anybody that says, well, I've got no competitors. Of course you have competitors. If you got no competitors, there's probably no demand for what you're selling anyway. I mean, it's possible there was no real competitor to this, but this was, radical change to what was available in the world. But 99% of the businesses, there's somebody out there solving their problem someplace. They may not be able to get a hamburger in town, but I'm sure they're getting pizza and subs, and maybe they're your competition too. They may not be direct competition, but they're solving the hunger problem in town that way.
Yeah.
So, you look at your competitors and say, well, what are they selling similar products to, if identical? And how am I going to differentiate myself from the competition so that I've got something to wean those customers away from the competition?
There is such a thing as market research.
Yeah,
in sales.
absolutely.
And there's also something that I think you like to talk about. It's called break-even analysis.
Right. Yep.
How many products or services you must sell to cover all expenses of your business?
Exactly. You should know what your break-even is every month. Personally, my personal preference is, if I walk into your company and say, what were your sales last month? And you say to me, I don't know, you're in trouble, okay?
Right.
Because by the 10th of the month, you should know what your sales were. Okay, you shouldn't think you know on the end of the month when you push the button, but after you really do produce a P&L, you should know what your sales were last month, and you should know what your total costs to operate that business for that month were.
Right.
And we'll talk about what do I mean by total costs in a minute.
Speaking of expenses, take a look at expenses and you have to know what these are. First is cost of goods sold.
Right.
What's
Those
that?
are variable costs. So like you've already said, if we're selling these things for $600, whatever this little black box is, doesn't matter, that we know we're paying a supplier $300 for it, then that's variable, because if I buy 10 or 1,000, it varies based on what it cost this thing, right? Doesn't count my rent for my store, it's just what I paid to get this thing in my building. It's variable,
Right.
It's based on how much I buy and how much I sell.
Right.
So there's variable costs, also known as cost of goods sold.
So it's cost incurred in creating a product
Exactly.
or service.
Or just buying it,
There's a cost of service.
right? Yep,
I mean, you don't have
All
to be
costs.
making something necessarily.
Right.
You are a service business.
Right.
But you still have cost.
you have variable costs based
And
on how
fixed.
many get out there and how much service you got to supply, right?
Okay.
So there's variable
So-
costs, also known
So
as
variable, directly related to sales volume.
Exactly. If I sold 1,000, that's one thing. If it's 100, that's another. Totally different number.
And you must know what what those numbers are, and they must be controlled,
Exactly.
right? And then there's another thing you mentioned just a minute ago: fixed expenses.
Right.
Now, fixed. So variable and fixed.
Exactly.
What's fixed?
Fixed would be something I've got to pay every month, and I'm doing this monthly. Whether I sell 100 or 200, it doesn't matter. Variable is going to change, but my rent doesn't change, does it? That's fixed. That rent figure.
The landlord wants that rent check.
It's 1,000 a month, whether I sell 100 or 1,000,
Right,
probably.
right.
So it's a fixed expense. It's not based on how many I sell.
Right.
It's based on what my costs are recurring every month, no matter what. Rent, of course, is one that I'm pointing to as a fixed cost.
So paid on a regular basis, regardless of sales level.
Exactly.
And but there are fixed expenses that you can so-called control
Yeah.
up and down, such as advertising, payroll,
Sure.
taxes.
Right.
There are things that are you can
You
manipulate.
can manipulate them up to a point. I mean, like you say, payroll. Well, sales aren't good. We're going to go into a down period. You may have to lay a couple of people off, so you can control that fixed expense up to a point.
Right.
And this is why you want to watch these numbers to make sure you do respond to what these numbers are telling you and what you see is coming up in the near future. And of course, advertising. Of course, you know, maybe you've got an advertising budget and you want to cut back a little bit on that because it's not going to be effective in the upcoming recession or whatever is happening. So you can control that to some degree. Now, I see people make a horrible mistake. Well, business is off. I'm not going to spend any money on marketing. And the next thing you know, it gets worse. All right. So you got to be careful making decisions like that.
Right. And there's additional terminology in your presentation, more terminology on business.
Yeah, just a couple of terms people should know.
Gross income.
Yeah, gross income is the top line, the revenue. How much money did I pull in last month? I pulled in $200,000 of sales, revenue, income, all the same thing. That's the top line, gross income.
Okay, and there's gross profit.
Right.
What's that?
That would be your gross income less those variable costs or cost of goods sold. So that would be gross income.
Of making this.
Exactly.
Okay, and then we mentioned you've just mentioned fixed expense.
Right. Now, once I've got that number, I can take out my fixed expenses, and that becomes my net profit before tax.
So then pre-tax profit.
Pre-tax profit.
Pre-tax.
Right. So there's just 2 or 3 terms that people should understand: gross income, net income, net profit. That's just, they have to understand those 3 things and how they work.
That's also for anyone, you know, that's what we call as, you know, internal, as we call bottom line.
Yeah, bottom line.
So I says, give me the bottom line. That's what the bottom line is.
Pre-tax, right.
Okay. And back to your idea of your discussion about break-even formula: gross income minus cost of goods equals gross profit, and fixed expense divided by gross profit percent is break-even.
Right.
Is that follow with your understanding?
Absolutely. I mean, what you want to know, like I said, I always want to know, what does each store break even at? If I got a call from my Fall River store, and at the end on the 30th of the month, other than February, that'd be 28th or 29th, but on the 30th, 31st of the month, I always got a call and said, we did $312,000 last month. And I just got the call. That's all I got at that moment. On the 10th of the month, I'm getting a full financial statement from that store. But at that point, manager of that store says, you did $312 last month. Hey, great, nice month, congratulations. Hang up, and I happen to know that my break even for that store that month might have been $220,000, so I'm feeling pretty good.
Yeah.
If I know my break even's $220 and he's telling me he did $120,000 of sales, I say, I know I'm going to lose money that month. I ain't happy about that. I might have a management decision coming up here. And I did with one of my stores. They weren't making money. And I said to them, you got 1 more year to either turn this thing around or I'm closing it. And guess what happened? They didn't turn around, and they weren't that shocked when I closed it. I'm not in business to lose money.
Yeah. We're going to come to your favorite of all time, which is cash flow.
CFIMITYM.
What is that?
Cash flow is more important than your mother.
More important
said that
than
in about 100 of these, out of the 200 shows we've done. I think I've said that on 100 shows. Absolutely. Cash flow is what keeps you in business, for God's sakes.
So positive cash flow.
Yep.
That's when it comes in is better than it goes out.
The gazintas come in before the gazoutas got to go out, and the gazintas is bigger than the gazoutas. So they're coming in before I have to write a check. So the money comes in before I have to pay for things. So I want to know, and what we do with cash flow is, it's a very simple thing. It's like balancing your checkbook. You look at what you started the month with, you look at what you ended the month with. Is it up or is it down? And then you look in between, you say, well, why did it go up or down? Because I wrote more inventory checks? Okay, so I might have lost cash that month because I piled up some inventory. I got a special deal on something. But you want to know where your cash goes. It's critical. I think it's the most important measurement, because with cash, you're still in business and you can make your Friday payroll.
Right.
But without cash, I don't care how much profit you're making, you're in trouble.
Positive cash flow.
Yep.
Your presentation says positive cash flow equals timing.
It's all about timing.
When?
When does the money come in?
Where's it coming from? How much?
Yep.
And when?
And then I'll know when I can send it out.
Right.
Right.
And also, one of your favorites is a warning to your audience. Remember, having cash is not the same as being profitable.
It is not.
And you have to explain that carefully to your audience.
Well, very simple. You might be generating a lot of cash because you're losing a lot of money and profitability, but your inventory is going down, so you're selling off inventory very quickly, and your cash balance is looking pretty good, but then your P&L comes in and you're losing money. On the vice versa is you might be generating a lot of profits, but running out of cash to do it because your accounts receivable are going up, your inventory is going up, and you're investing a lot of your cash in assets, but they're not cash. Accounts receivables, not cash. Inventories, not cash. They're assets, but they're not cash. There's a difference. It goes beyond the scope of this particular program to really dig into that, but you better understand the difference between profit and cash flow, because cash flow is critically important to a business, especially what the Boston Consulting Group calls a star business, because that business is growing. It's going to eat cash. You got to figure out, where am I going to get the cash from to keep this business growing?
Well, you just said we have to have another show then, I guess.
Oh, there's a lot more shows to do about that one alone, yeah.
And we're bringing you to the twin pillars of financial statements, the biggies. The biggies: balance sheet, P&L,
Yep.
profit loss,
Right.
income statement.
Yep.
Balance sheet, income statement.
Yep.
And starting with the balance sheet,
Yep.
you said that that's a snapshot?
Snapshot in time. It's as of December 31st, January 1st, could be any date. It's what do I own on that date, or what does the company own on that date,
OWN.
right, and not Oprah's Winfrey Network, equals what the company or I owe on that date,
OWE.
and the difference is Mayans. So again, to just use the one example of, gee, I own a house, or the company owns a piece of equipment, and the value of that equipment today is $500,000, but we still owe $300,000 on it. Therefore, the equity we have in that piece of equipment, that piece of capital equipment, that printing machine, that manufacturing machine, is $200,000.
That's it, guys. You know, you look at a balance sheet, look at all of those numbers. What I own,
Yep,
what I owe, and what's left over for the owners.
is exactly right.
Okay. And the balance sheet, so don't overcomplicate it. The concept is easy to understand.
Very easy.
Sure, you get into the details,
Yeah, right,
there are complications.
right,
But the concept is simple.
absolutely.
And then the income statement, that's the other twin pillar. Income statement. Coach, you call that a movie,
Exactly.
not a snapshot.
Right. It's not a snapshot as of a day. It more of a movie. A P&L or an income statement, it's the same thing. We just call it two different things, and I don't know why, except maybe some people don't like to use the L word. I'm one of them, P&L. So the income statement basically runs from this point to that point. So your income statement, I got an income statement every month. It ran from January 1st to January 31st. The next one ran from February 1st through February 28th or 9th.
Right.
So it's a period of time. It's like taking this thing and putting it on video and running it. And income statement, of course, could run from January 1st to December 31st. A whole year, could be a quarter.
Right.
But the difference between a balance sheet, which is a snapshot as of a particular moment in time,
Right.
the income statement covers a period of time. That's the difference, one of the main differences.
And the income statement, of course, telling you whether you're achieving profit or loss is income,
Yep,
cost of goods,
yep,
gross profit, expenses, taxes, interest, net profit.
exactly what we were saying before about variable costs and fixed costs. Making sure you pick up all of the variable costs and all of the fixed costs, picking up all the costs, matching it against that top number, which is gross income, revenue, sales, whatever you want to call it, and that's going to give you a projection if it's, a future thing. Here's what the company should show as a profit before it's out.
We threw taxes and interest in that they're not considered operating expense.
No, well, interest is...
They're an expense. You got to
Yeah.
pay a tax.
Yeah.
You got to
Yeah.
write a check
Yeah.
for tax, but it's not considered part of your the operation of your daily operation.
No,
of your
but
business.
interest is.
But interest is.
Yeah.
Okay. Net profit. Net profit. That's quote, folks. That's the bottom line.
Bottom line before tax, right?
That's the truth or
Yep.
consequences.
Right.
Okay.
What you get to keep.
Now, let's take a look. Let's switch to the person who's starting the business
Yep.
or operating the business. We're going to call her Mary.
Yes, Mary.
And Mary has a financial picture,
Yep.
which is her income. Say in your example, this is
Yeah,
an
a
example
nice
only.
simple. Seed put this together. But a nice simple example. Instead of confusing, is it a business? Is it personal? This is Mary's financial statement.
Yeah.
Whether she's a business or an individual, right? So go ahead.
For income, $4,000 a month.
Yeah, she makes $4,000 a month gross. Top line, $4,000.
We just picked that out of the
That's
sky.
right. Just pick a number.
But her expenses, she added up all those expenses. It was
Yep.
$3,600.
Right. She spends $3,600 to live, so she's saving the difference, which is $400 a
That's
month.
$400.
That could be considered her profit, if you would.
And she puts that in savings, which
Yes.
that's nice.
She has been doing it for a long while.
So that savings deposit is that $400
Right.
bucks.
Every month.
And she bought a used car
She bought a car for
to get
what?
to work for $6,000
Right. It was,
on credit though,
yeah.
not in
No.
$6,000 in cash.
She put
but in credit.
$1,000, as you'll see, $1,000 down on the car of her cash, and she borrowed $5,000. So just on the car alone on her balance sheet, it will show her personal financial statement shows she has a $6,000 car
Yeah.
and a $5,000 debt, which means she's got $1,000 of equity, which is what she put down
Yeah.
to buy the car.
Right. Down payment,
Yep.
1,000. Loan, the balance,
Right.
5,000. 6,000 minus 1 equals 5,000.
Right.
Also, purchasing a house,
Bought a house.
$300,000 house.
Right.
Average. That's is that an average? That's an average house.
Back in 2007, that was a 14-bedroom mansion. Right now, it's a two-room house on Cape Cod with no bathroom.
Down payment, 10%, 30,000.
Right.
The balance left over, 270,000 in
Right.
debt.
So again, she now owns as of that day a $300,000 asset, a house. She owes $270,000 on it. She's got $30,000 worth of equity, which is the money she put down on it. So that's what would appear on this balance sheet.
Well, take a look at her Mary's balance sheet.
Yeah.
Assets, the deposit $400.
Yep.
That she deposited.
That's her cash on hand.
But the car, $6,000. That's a market value of the
As
car,
of that day.
Of that day, and the house, $300,000.
As of that day.
As of that day. Total assets, $306,400. Well,
Right.
Okay. And then on now the liability side.
Right.
She has a mortgage loan, loan of $270,000.
Right.
Because she made a $30,000 down payment.
Right.
She has the car loan of $5,000 because she paid $1,000 down.
Right.
She still owes $5,000.
Right.
And so the liability is $270 plus $5, $275,000.
Right.
$1,000.
Yep.
Okay. But then her equity
Right. Is the difference
is the difference.
between $306,000 of what she owns,
Right.
right, and the $275,000 that she owes, and you add what she owes and the net equity, if you will, or net value of that. Add those two numbers up, they got a balance.
Right.
They both have to say the same number on the right and left-hand side. That's why we call it a balance sheet.
And that's the snapshot for today.
As of a day,
Now her income, Mary's income statement,
this is the income.
the
of P&L.
$4,000 salary, $4,000.
Yep, every month.
Mortgage payment,
Every month.
$2,000.
Right.
Food, $500. Utilities, $400. Insurance, $100. Auto
Every
payment,
month.
$300.
Every month.
Miscellaneous, $300.
Every month.
$3,600.
That's what she's spending of the 4,000
Okay,
sales,
so
revenue, top
right.
line, income, whatever you want to call it.
Right.
And she spends those things, and 400 is
And
the
then here
difference.
comes the 400.
Right. 400 of profit, if you will.
Okay, that's good. And so as a result of this, there's an outline of do's and don'ts.
Yep.
This is the advice
Yep.
part
Right.
of your presentation, such as do not, that is do not, D-O-N apostrophe T, do not provide only an income statement when you talk to
A lender.
a lender like Seed
Right.
or Seed Corporation or others, a bank. Do not provide only an income statement, provide a balance sheet
Yep.
and cash flow. along
Absolutely.
that.
They want all three. They want the P&L, income statement. They want a balance sheet for the business, the pro forma, if it would be, meaning what the business is going to look like.
No.
And they want that cash flow statement because you got to show them how you're going to pay them back. And the cash flow statement and the P&L, basically, those two tie together, and that tells them how you're going to pay the loan
So
back.
when you talk to that lender, you better have those.
You better have all three of those.
It says also, this is a do,
Mm-hmm.
this is a positive idea, do provide monthly data
Right.
for the upcoming year.
Yep.
Annual data for, and annual data for the succeeding year.
Yep.
So that would be this year, plus a look-see for the
My
the
first
following year.
projected year in business, I'm looking for a loan. I'm hoping to start the business June 1st. I'm going to project by month, June, July, August, right through to next May, by month, my revenue, all of my expenses, my cash flow, what my assets are to start, what my net worth will be at the end of the period. I'm going to do that by month for the first year that I'm projecting I'm going to be in business, called a P&L. It's a pro forma P&L, meaning here's what I think my business will look like next year by month. The second year, you could give them annual or quarterly if they prefer. You don't have to give it to them by month.
Estimate.
That's just an estimate of what the business
projection.
is going to look like in year 2.
But
or
do
3.
not, here's a don't again, do not provide more than 3 years
Right.
of financial projection
You can't.
unless requested.
It's unless requested. Usually 2 or 3 years is plenty.
Okay.
Plus, it's
And-
starting to get way out there. Who the heck knows? It's really a scientific guess at that point.
Also, when you talk to the lender, do not bother to include every
No,
detailed
they're
line
not.
item for expense, asset, liability. It's overkill.
That's all.
Too much detail.
They don't want all of that detail. They'll dig into that maybe at a later time, but when you first present it to them, they just want to know, show me the numbers. Show me what your income's going to be.
Right.
Show me what all your expenses are going to be, what you project for a net profit. Show me what your cash flow is going to look like. Show me an opening balance sheet. Might not even want a balance sheet at the end of the year. Who knows? They'll tell you exactly what they need. But they need 3 statements, and they also need a personal financial statement. Not only the projections for the business, they want to know who this person is that's going to be starting this business. And that would be a
do
person.
be honest and accurate. Thank
Oh, you
you
better
very
be.
much.
They're going to check. They're going to check. You can't lie to them and,
And do not provide more than 2 financial projections. I mean, 1 is good enough, but maybe 2 alternatives like a high-low or something like that.
Something like what's really expected and the minimum maybe that you could get by, or here's what I really expect to do, but if things go well, this could be, but don't give them 4 or 5 different projections. Give them 2 based on something that makes sense. A lot of lenders will say, give me the worst case scenario. I don't tell my client to do that. Because don't give them a worst case scenario. This is my opinion. Give them something that makes sense, that this is really what I think this business is going to do, because it's the next sheet that explains how you think that's going to happen that's going to back that up.
But make sure the numbers reconcile.
They got a foot. They got to add up
equal.
correctly, and all the numbers on the different pages. I've seen business plans go in, and one says they're going to sell 600, and then they do the P&L. It says they're going to sell 800, and you say, wait a minute, let's tie it all together.
And don't be too optimistic.
No.
Don't be overly optimistic.
No, because they're going to say your words don't back up these sales, and you're not going to do 10 million in your first year. It doesn't make any sense.
And show reasonable interest expense.
Exactly.
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 Okay. Thank you, Coach.
You're welcome.
And thank you guys for watching. Make sure our shows, all of our shows are on YouTube. Go to YouTube and put in the search box Fox Robbins, FOXROBBINS, and click into the library and select an episode that is of interest or current interest to you. And thank you for watching, and we'll see you guys next time.